All right, gang in studio with us. Always smelling good, always looking fine. My favorite guy in the mortgage industry, Mr. Brian Johnson of Valley Mortgage. Good morning, BJ.
Hey, good morning, Eric.
Life is good lately?
It is, yes.
Okay, you and I got to attend the Bison Bitters Bowl together.
We did.
Our wives were looking way prettier than us.
Always, yes.
Did you buy anything you didn't need?
Not this time, no.
I bought some art I didn't need.
You did?
Yeah, I
Wonderful.
did. I am a sucker for live and silent auctions. Like literally, I whatever crap I don't need, I'm like, oh, I better purchase this. It's for the kids.
There you go. That's right. Makes sense.
Brian, those people tuning in who haven't heard you on air before, you're with Valley Mortgage. Tell us about Valley Mortgage, what it is, what you do.
Sure. We're a local mortgage banker. We've been around since 1983. We moved offices earlier this year, so we're at 3315 45th Street South in Fargo. So we specialize in home loans only. We don't do any checking, savings, other products. So we are experts in our field, and we do purchase loans, refinances, new construction, FHA, conventional, VA, USDA, and jumbo loans.
Okay, yeah, that was a lot of mumbo jumbo.
Yep.
What you're saying is you guys do and cover anything when it comes to a home loan, right?
We do, yes.
Okay, I've been getting some emails from one of your partners lately, and there's some changes that are happening recently. There's some loosening up and some more opportunities. Is that right?
There has been, yes.
Okay, tell me more.
A lot of the guidelines that were in place that all the lenders follow have really tightened up after the mortgage meltdown and from 2008, 2009.
Okay, so let's rewind the mortgage meltdown. What was happening before the mortgage meltdown, and what happened immediately thereafter?
Sure. So in the early 2000s, up until about 2007 or so, the mortgage industry kept loosening guidelines, and people were getting into loans that they couldn't afford, loose documentation or no documentation. So it was really kind of chaos for the housing market.
Basically, if you could fog a mirror, you could get a home loan, right?
Right.
The barrier for entry was incredibly low.
That's very true. Yes.
Okay, so that's when I got a couple home loans. Don't worry about it.
Right. And you were able to get in with no money down, and you were able to buy investment properties with no money down. I mean, it was a little bit scary. There was not a lot of risk that the consumer had in place. So.
But what happened as well is properties were rapidly increasing, right, in price because of this. It was a supply and demand model, right?
Values were going up significantly. And then in the bigger markets, too, they were going up exponentially higher than around here.
So somebody would pay $300,000 for a house with $0 down, shoddy credit, and then that home realistically should only be worth $200,000, but it was inflated.
Correct, yeah. Values had gone up quite significantly. Year over year, I mean, you were talking 15-20% in markets each year that increases. So that was having quite
4% is an average increase,
right?
And you said 15 to 20%. That's like my weight. Like you shouldn't put on that much weight. But have you had food before, Brian? It is wonderful.
That's right.
15 to 20% of my weight just comes on every year.
Yeah.
So up until 2000, I'm sorry, I'm so hungry right now. Up until 2007 or 2008, it was really easy to get a loan.
It was.
Then you said there was a mortgage crisis, or there was a freeze, or there was a meltdown. What happened?
Well, that's a long story. We could spend an hour on that, but pretty quickly the market kind of tumbled. Fannie Mae, Freddie Mac, all the investors and different banks basically were failing. So they had a knee-jerk reaction, tightened up all of the guidelines, and then made it very difficult to get a loan.
So it went from super loosey-goosey to incredibly conservative.
Right. And so we spent probably 4 or 5 years after that, not we, the market did, trying to figure out what was actually a good risk, a healthy risk, let the economy get back on track, let the housing market get built back up. Now you've slowly been seeing over the last probably 5 years things loosening up slowly.
So are we getting back to as crazy as it was in the early 2000s, or is it that loose again?
No, it's not at all. You still have to, lenders have to require borrowers to be able to afford their homes, let's say.
Right. So there's actually still rules.
It's still common sense rules, and,
okay.
And you have to show that, hey, the borrower can afford their home. You're not putting them in a bad financial situation.
Okay, so there's still guidelines. And so now things have loosened up, and places like Valley Mortgage can offer opportunities that you weren't able to offer previously. What are a couple of those opportunities?
There's a lot of different things with, if somebody doesn't qualify, we can offer co-signers. We look at somebody's full financial picture and we'll offer advice on how to restructure debt or refinancing loans, and so you're able to get into a loan, a better loan for you. If you're looking at selling your home and moving up, we take a look at the full picture and to say, okay, rather than putting 20% down, let's have you put down a little bit less, pay off some of these other high interest debt and things like that. So we'll look at some of those things. Student loans are a big issue currently.
Yes, they are.
We have some different programs available that I don't think anybody else in our marketplace does. So sometimes we're able to not count those against people for qualifying.
What?
So
that's asinine and exciting.
that is, everybody has student loans, so it's a big.
If they went to college, that's making a nasty assumption, Brian. I saw an email come across that said that you can avoid an appraisal.
Yes.
How in the world can you avoid an appraisal if you're getting a mortgage?
There is a lot of data out there that the agencies collect, and so if a home has been sold before, and in a certain timeline, it looks at the appreciation model, and if as long as
4% dish, I mean, it depends on the neighborhood and the time.
Yep. So they'll look at when it was sold last, how much it was sold, what the comps are sold for in the area. So as long as it has sold before, typically we see if someone with good credit, as long as they're putting 20% down, a lot of times we're getting appraisal waivers where we don't need to have an appraisal done.
That speeds up the process so you can close faster. That lowers your closing costs by $600 to $700.
Appraisals are quite high in our market compared to other places. So that saves a lot in closing costs.
Lowers costs, increases speed. And I have to tell you, if I'm representing a seller in a transaction and somebody comes forward and provides an offer that says, I don't need an appraisal on this offer, that is a shining star winner against a lot of other properties because there's not that trap door that could happen for a seller.
Right.
That's a huge opportunity. Brian, if folks want to talk about all these unique things that you're offering and the loosening of guidelines, how do they get in contact with you?
Sure. Call my office at 701-461-8450 or visit us online at valleymortgageinc.com.
Brian Johnson, you are a beautiful son of a gun. Great to have you in studio with us. Folks, we're heading to break. Go to livefargomoorhead.com to find out what your home is worth. This is Real Estate Radio with Erik Hatch.